Hello everyone, and welcome back to The Explainer. Today, we're diving right into Day 30 of the incredible Summit Heracles Masterclass series. We're looking at a definitive guide on the inventory audit. If you've ever wanted to truly understand how professionals protect a company's most tangible assets, well, this is it. Grab your notebooks because we are getting right into the nitty-gritty of internal auditing today.
Okay, let's dive into this. Here is our roadmap for today's masterclass. We're going to cover objectives, key risks, and key controls, walk through an inventory process example, detail the audit procedures and focus areas, spot common red flags, and then finish up with the impact and key takeaway. Let's get started.
To set the stage, let's look at exactly how this masterclass frames our roadmap. Inventory represents a significant portion of current assets and plays a critical role in operations and financial reporting. An inventory audit evaluates whether inventory is accurately recorded, properly valued, safeguarded, and managed efficiently to ensure reliability of financial statements and operational effectiveness. Remember that core idea: accurately recorded, properly valued, and safeguarded. Let's break down exactly how we pull that off.
Section 1. Objectives. What exactly are we trying to achieve here?
An auditor's primary goal isn't just checking numbers on a screen, it's confirming reality. So our objectives are to ensure existence, ensure accuracy, ensure proper valuation, ensure proper classification, ensure safeguarding, and ensure compliance. That safeguarding piece is absolutely crucial. Think about it like this: you're ensuring physical security measures like locked cages in a warehouse are actually functioning properly to prevent someone from just walking out the back door with your most expensive inventory.
Section 2. Key risks and key controls. This is really the dual nature of auditing, identifying exactly what can go wrong and how we fix it. Auditors are constantly on the lookout for anything that distorts the truth. Here are the 7 main culprits: inventory not recorded correctly, overstatement or understatement, obsolete stock, loss due to theft, incorrect valuation, inadequate segregation, and non-compliance. Now, the ones that should really keep you awake at night: inventory loss due to fraud or theft, and inadequate segregation of duties. Seriously, the person counting the inventory shouldn't be the exact same person authorizing its disposal. Vulnerabilities like that can literally cost an organization millions. Now, what's really interesting about this slide is how we neutralize those exact threats. We implement key controls as direct shields. They are proper authorization, physical security, regular stock count, timely record updates, proper classification, segregation of duties, approval for write-off, and review of obsolete inventory. These are your direct, practical solutions to the risks we just talked about. Moving on to Section 3, Inventory Process Example. We are now going to walk step by step through the exact life cycle of inventory.
Let's trace a practical example. Say, raw material Model A. The journey starts with the intake phase. Step 1, purchase requisition. The production department realizes they're running low and raises a request. Step 2, purchase order, or PO. That requisition becomes a formal order sent to the vendor. Step 3, goods receipt. The materials arrive and are checked against the PO. And Step 4, record in inventory. The Model A material is officially logged into the system.
Once it's in the system, we track it. Step 5, storage. Our raw material Model A is placed securely on the storage rack. Step 6, issue to production or sales. It leaves the rack based only on authorized requests. Then we hit the core of the audit. Step 7, stock take, doing the actual physical count. And finally, Step 8, reconciliation. This is where that physical count from the floor is matched directly back to our book records.
Section 4. Audit procedures and focus areas. Now, we shift our focus to the actual day-to-day work of the auditor.
The work of an auditor follows a very rigorous pipeline. Let's go through the exact procedures. Understand process, review policies, test controls, observe physical count, perform test counts, reconcile with books, review valuation, analyze aging, review write-downs, and verify disclosures. You absolutely have to hit every single one of those to do the job right.
And this brilliantly illustrates where an auditor's magnifying glass actually hovers. The exact areas to focus are existence and accuracy, valuation method, cutoff, obsolete stock, aging and turnover, physical security, segregation of duties, write-offs, system access, and compliance. And when we talk about compliance, we absolutely must explicitly ensure it aligns with standards like IND AS2 or IAS2, no exceptions.
Let's move to and see how this builds into a healthy transaction record for our earlier Model A example.
Check out these exact rows of data. Item: raw material, Model A. PO: PO-4587. Vendor: steel supplies. GRN: 7900. QTY: 1000. Cost: 120. Value: 1,200,000. Storage: WH-01. Issue: 600. BAL: 400. Check, matched. Notice how every single piece of data perfectly aligns? That end-to-end traceability is the gold standard we're looking for.
Section 5. Common red flags. Now let's pivot to the warning signs every single internal auditor absolutely must memorize.
When things don't align perfectly, we look for these 8 warning signs. Large count differences, frequent write-offs, high-value obsolete stock, improperly recorded, unauthorized access, no regular count, negative stock, and inadequate documentation. Listen, some of these are catastrophic. Having negative stock in your system, that is physically impossible and represents a massive, massive system breakdown. And frequent write-offs? That might not just be bad luck. It could easily be a mask for ongoing systematic theft.
Section 6. Impact and key takeaway. Let's bring this all together and explain why this rigorous work actually matters for an organization. A successful audit does way more than just catch bad guys. The impact of an effective inventory audit ensures accurate reporting, reduces losses, improves efficiency, optimizes working capital, ensures compliance, and supports better decision-making. When you actually optimize your working capital, you free up vital cash flow, and that directly supports high-level executive decision-making. It's a total game changer.
So the crucial point is this. Think of this as the core philosophy of Same Heracles' methodology. A well-controlled inventory process with regular monitoring, accurate records, proper valuation, and safeguarding ensures the right quantity of inventory is available in the right condition at the right cost and at the right time. It all distills down into one neat formula, the effective inventory audit equation. Effective inventory audit equals accurate records plus physical verification plus proper valuation plus strong controls plus timely reconciliation plus good inventory management. Master those variables and you've got it. As we wrap up today's masterclass, I want to leave you with a provocative thought. What happens to a business that ignores these exact standards, ignores these red flags, and completely loses control of their inventory? Think about the massive potential for catastrophic financial failure. Let that sink in and get ready, because you will definitely want to be here for day 31 of the curriculum. See you on the next explainer.